to the Institutional Order Flow Masterclass. Today, we are breaking down the exact mechanics of how major banks and institutional algorithms engineer liquidity to trap retail traders. Look closely at this daily charm gold to an untrained retail eye. This structure represents a textbook double bottom pattern forming a highly reliable key support zone. Retail textbooks tell you to buy the bounce at this level and place your stop loss is right below it. But as an institutional trader, you must realize that this strong support is nothing more than a beautifully engineered illusion. Right beneath the dashed line lies a massive pool of sell-side liquidity. Millions of dollars in retail stop losses are sitting there, waiting to be harvested by smart money. Notice the exact moment the trap is sprung. The market makers don't just gently tap this level. They drive price down with aggressive institutional volume. This sudden, violent downward expansion is what we call a liquidity sweep. Ora stop bihun. Look at this massive candlestick wick cutting straight through our green support line. In a matter of minutes, thousands of retail buy positions were stopped out, forced to sell their contracts at a discount, while retail trade panicking, thinking the market is crashing. Smart money algorithms are doing the exact opposite. They are utilizing that massive influx of retail sell stops to fill their own institutional buy orders at the absolute best possible price. They need your selling pressure to execute their massive buy blocks. Once the liquidity is completely cleared from the marketplace, the true intent of the smart money is revealed. Price reverses violently to the upside, creating massive displacement and breaking previous key structural highs. This aggressive move leaves behind clear institutional footprints that we can track. First, we identify the institutional order block highlighted here in the white circle. This represents the final down close candle before the impulsive upward displacement. Second, notice this massive imbalance left in the price delivery. This is our fair value gap, or FVG, because the banks moved the price so rapidly. An inefficiency was created where only buyers were matched. The Markov algorithm is structurally obligated to return to this displacement zone to rebalance the price delivery before continuing higher. This brings us to our precise execution model. We don't chase the market when it's rallying. We wait patiently for price to retrace and mitigate our high probability zones. As price drops back down to rebalance the fair value gap and taps perfectly into our institutional order block, we get our confirmed smart money entry right inside this green crosshair. Our risk is minimized because our invalidation level sits safely below the institutional swing low, while our target rests on the opposing buy-side liquidity pools. The result: a clean, high-probability expansion straight to the upside, trading entirely in alignment with the institutions. Stop trading the retail patterns, stop being the liquidity, and start hunting it. Make sure to subscribe to Liquidity Hunter for Part 2 of this institutional masterclass. See you in the next session.